The markets are closed. The screens are dark. The ticker is frozen at exactly $79.25. To the average person, it's just a holiday weekend. But if you could look inside the risk management boardrooms of Lower Manhattan right now, you would see absolute panic. We have warned about the mathematical breaking point on this channel for months. We analyzed the supply deficits, the industrial drain, and the paper-to-physical ratio. Well, based on the data profile of Friday's close in this simulation, that point isn't coming in 2026. It happened 48 hours ago. What I want to do right now is walk you through a forensic reconstruction. We are running a simulation of a scenario that is no longer theoretical. The data suggests this is a mathematical certainty waiting for a catalyst. So, let's assume we are standing in that moment right now. Let's assume it is Sunday night. The markets are about to open in Asia, and the Western financial system is holding its breath. Why? Because on Friday afternoon, the price of silver didn't just tick up. It didn't just have a good day. It ripped. It moved 10% in a single trading session, closing at historical highs of $79.25. Now, if you are a retail investor, if you are holding a stack of coins in your safe, you are celebrating. You are looking at the screen and doing the math on your net worth. You are thinking about the new car, the paid-off mortgage. But the institutional side, the smart money, the entities that structure the global derivatives market, they aren't celebrating. They are vomiting. We are receiving indications within this scenario that emergency risk management meetings have been occurring continuously over the last 24 hours. The lights are burning late at the Federal Reserve building in D.C. The conference lines are active between the major bullion banks, the market makers who provide liquidity, and the clearinghouse at the CME Group. You have to ask yourself, why? Why call an emergency meeting for a commodity rally? Commodities go up and down all the time. Oil spikes. Wheat spikes. Why does a 10% move in silver trigger a systemic alarm that reaches the highest levels of the Fed? It is because you need to distinguish between a trading event and a solvency event. This is the core concept you must grasp to understand the gravity of this weekend. When silver moves 2% or 3%, that is a trading event. Money moves from the bears to the bulls. Some traders have a bad day. Others have a great day. The system functions. The liquidity flows. But when a core monetary asset like silver moves 10% in a single day against a massive concentrated short position held by the banking sector, it stops being a trading event. It becomes a solvency event. It breaks the risk models. Every major bank operates on a value at risk model, or VAR. They calculate the maximum amount they can lose in a single day with a certain confidence level. A 10% move is a statistical anomaly. It is a Six Sigma event. It is something that their computers say should not happen in a million years. When it happens, it blows through the safety buffers. It triggers immediate, automated margin calls that are larger than the available cash on hand. And when that happens on a Friday close, heading into a holiday weekend where the banking windows are closed and liquidity is non-existent, you have a recipe for a heart attack. This is why they are meeting. They are looking at the ledger, and they realize that technically the liabilities exceed the assets. They are looking at a hole in the balance sheet that appeared out of nowhere in 6 hours of trading. And this brings us to the spine of the crisis, the clearinghouse. Most people don't think about the clearinghouse. They think about the buyer and the seller. But the clearinghouse is the central counterparty. It sits in the middle. It guarantees every trade. It tells the winner, I will make sure you get paid. And it tells the loser, I will make sure you pay. Ideally, the clearinghouse is a fortress. It is capitalized to withstand shocks. But it is not capitalized to withstand a total collapse of its largest members. If a major bullion bank cannot pay its debts on Monday morning because they were short silver and got blown out by this vertical move, the clearinghouse has to step in and pay. They have a default fund for this exact purpose. But that fund is finite. It is deep, but it has a bottom. If the losses from the silver spike exceed the size of the default fund, the clearinghouse itself is at risk. And if the clearinghouse fails, the system freezes. The plumbing of the global financial market clogs up. The ATMs stop working. The credit lines dry up. Trust evaporates instantly. This is the nightmare scenario. This is what happened in 2008 with the mortgage-backed securities, but this time the toxic asset isn't a complex housing bond. It is a short position on real money. So, let's be very clear about what is happening behind those closed doors. They aren't meeting to manage volatility. They aren't discussing orderly markets. Those are polite euphemisms for the press release. They are meeting because the clearinghouse is staring at a black hole. They are looking at the order book for the Sunday night open in Asia, and they see no sellers. They see a vacuum. They are terrified of the Sunday night open. They know that the psychology of the market has shifted. They know that if silver gaps from $79 to $85 before Western liquidity returns on Monday morning, the margin calls will exceed the capitalization of the firms holding the shorts. The game might be over. The structure of the futures market might simply snap. They are trying to figure out how to stop the price from discovering its true value. They are trying to figure out how to put the genie back in the bottle before the opening bell rings in Tokyo and Shanghai. But the problem is, the math is against them. The physics of the market are against them. This is the story of the weekend the system blinked. But to understand why a bank with trillions in assets is scared of a metal trading at $79, you have to understand the math of leverage. And the math says, they are already dead. Let's do the math that the mainstream media refuses to show you. It's simple, it's brutal, and it explains everything. We talk a lot about paper silver versus physical silver on this show. Usually it's an abstract concept. It's something we complain about regarding price discovery. But tonight, that distinction isn't just a grievance. It is the mechanism of the crash. The disconnect between the paper price and the physical reality has finally snapped back, and the kinetic energy released by that snap is what is destroying the balance sheets of the bullion banks. I want you to look at this spreadsheet I've pulled up. This is a simplified model of a typical market maker's book. This is how the sausage is made, or in this case, how the wealth is destroyed. These institutions do not trade with their own cash, dollar for dollar. That would be too slow. That wouldn't generate the quarterly bonuses. They trade on margin. They use leverage. In the silver futures market, the typical leverage ratio for a major liquidity provider can range from 20 to 1, sometimes up to 50 to 1. Let's be conservative. Let's assume they are running at 20 to 1. Do you understand what 20 to 1 actually means? It means for every $20 of silver they control or sell short, they only have $1 of actual equity, actual cash, sitting on the table as a performance bond. That is a 5% margin requirement. It works beautifully when the market is quiet. It works beautifully when they can nudge the price down and collect the spread. It's a money printing machine. Until it isn't. Because leverage is a double-edged sword, and on Friday the sharp edge swung right at their necks. Here is the death math. If you have a 5% equity cushion, and the price of the asset moves 5% against your position, you don't just lose 5% of your money. You lose 100% of your equity. You are wiped out. Zero. Now look at what happened on Friday. Silver didn't move 5%. It moved 10%. At a 10% adverse move, you haven't just lost your equity. You have lost double your equity. You have gone through zero and come out the other side. You are now technically insolvent. You owe money that you do not have. And when you multiply that hole in the account by the billions of ounces of paper silver that are traded daily, you realize the scale of the problem. We are talking about billions of dollars in losses that materialized in hours. Usually, in a normal market, this is where the margin call happens. The exchange calls the bank and says, post more cash, or we liquidate you. Or the bank calls its client and says, pay up. But here is the terrifying part of this scenario. Who do you margin call when the entire sector is on the wrong side of the trade? You cannot liquidate a position this size without crashing the market further. If they tried to buy back their shorts to cover the loss, they would drive the price from $79 to $150 in minutes. They are trapped in the burning building, and the exit door is painted on the wall. And this brings us to the second half of this disaster. The supply-air gap. In a normal crisis, the banks might try to solve this by physically delivering the metal. If they are short, they could go out into the physical market by the 1,000-ounce bars and deliver them to close the contract. It's expensive, but it stops the bleeding. But they have run into a wall. The physical market has gone dark. We are seeing reports coming out of Mexico and Peru, the heartlands of global silver production, that the major miners are engaging in strategic withholding. Think about it from the miner's perspective. You are a CEO of a silver mine. You see the price ripping higher. You see the panic in New York. Do you sell your silver today at $79? No. You lock the gates. You stockpile the ore. You wait. Because you know that if you wait a week, you might get $100. So the new supply is choked off. At the same time, we have the industrial whales, the tech giants, the solar panel manufacturers. They aren't looking at the COMEX price. They are looking at their production lines. They know they need silver to build their missiles, their servers, their EVs. They are bypassing the exchange entirely and doing off-market deals. We are seeing signs that they are buying bulk inventory directly from refineries at massive premiums, just to secure supply. So the float is gone. The inventory that the banks rely on to bail them out, it isn't there. This is a supply air gap. The banks are reaching for liquidity to cover their shorts, but they are grabbing thin air. They sold more silver than exists, and now the owners want it back. The squeeze is on. It is mechanical. It is mathematical. And it is relentless. There is no way to untangle this knot with the current set of rules. The shorts cannot cover because there is no metal. They cannot pay because they are leveraged into oblivion. So the banks are underwater. The metal is gone. In a free market, this is where they die. But we don't live in a free market. When the house is losing, they don't fold. They change the rules. Let's take you inside that emergency meeting. Right now, as we speak, the lawyers are reading the fine print of the COMEX rulebook. They aren't looking for a way to pay you. They are looking for a clause to stop paying you. We have seen this movie before. We saw it in March 2022 with the LME nickel crisis, when the London Metal Exchange simply canceled billions of dollars in trades because a Chinese tycoon was on the wrong side of the bet. We saw it in 1980 with the Hunt brothers, when the exchange changed the rules overnight to liquidation only to force the price down. History doesn't repeat, but it rhymes, and right now the rhyme scheme is spelling out default. I want to take you inside that room. Based on the rulebook precedents and the severity of the leverage blowout we just analyzed, we can reconstruct the options on the table. They are looking at a menu of bad choices, and they are trying to pick the one that doesn't incinerate the dollar. The first tool they are likely discussing is the margin hike. This is the standard first response. They could raise the margin requirement from 5% to 100%. This means if you want to hold a silver contract, you can't borrow money anymore. You have to put up the full cash value of the contract. In theory, this flushes out the speculators. It forces the hedge funds to sell because they can't afford the cash call. But here is the problem. The buyers driving this rally aren't just hedge funds on leverage. They are cash buyers. They are industrial entities. They are sovereign wealth funds. If you tell Samsung or the People's Bank of China they need to pay cash, they just pay cash. They have the liquidity. So a margin hike might hurt the small fish, but it won't stop the whales. It might even backfire by signaling to the market that the exchange is desperate. The second tool is position limits. They could arbitrarily tell the biggest longs, you hold too many contracts. You must sell half of your position by noon on Monday. This is direct intervention. It's effective in the short term, but it destroys confidence. If you force a buyer to sell, you are admitting that your market is rigged. And that leads them to the nuclear option, the weapon of last resort. The rule change that ends the free market entirely. Liquidation only. This is the scenario you need to be prepared for on Monday morning. The exchange could issue an emergency order stating that effective immediately, traders can only place orders to sell contracts to close out existing positions. No new buy orders allowed. Think about the mechanics of that. If you turn off the buy button, what happens to the price? Can only go down. There is no demand allowed on the platform. It forces the price to collapse artificially, allowing the insolvent banks to cover their shorts at a lower number and survive. It is a bailout funded by the profits that should have gone to the longs. But here is the twist. Here is the mechanism that makes this time different from 1980 or 2022. Here is the problem they can't solve, no matter what rule they rewrite. They can control the paper market in New York. They can rig the computer screen to show $79 or $60 or whatever number saves the banks. But they cannot control the physical market in Shanghai. They cannot control the street price in Mumbai or Dubai. If they trigger liquidation only and suppress the price in New York, they create the greatest arbitrage opportunity in history. Imagine this. The COMEX price is forced down to $79. But the physical demand in Asia is still raging, and the Shanghai Gold Exchange is trading silver at its true value. Let's say $110. What happens? The great decoupling. Every algorithm, every trader, every physical dealer will instantly buy the cheap silver in New York and sell it in Shanghai. They will drain the COMEX vaults. They will take delivery of every single ounce that is sitting in the registered inventory in New York and ship it east. The exchange thinks they are saving the system by lowering the price. But by creating an artificial price that is lower than the real-world price, they are effectively putting a for sale 50% off sign on America's strategic silver reserves. This is the intervention paradox. Their solution creates a permanent break. We will see a bifurcated world. A paper price in the West that is irrelevant, a zombie number on a screen, and a physical price in the East that dictates the actual cost of metal. The COMEX becomes a museum, a place where paper contracts trade, but where no metal ever moves, because there is no metal left. This is the specific nightmare that the regulators are wrestling with this weekend. They know that if they use the nuclear option to save the banks, they lose the metal. They hand the keys to the global silver market to China. It's a geopolitical catastrophe disguised as a financial rescue. And that is why the panic is so palpable. They are trapped between hyperinflation of the price if they do nothing, and the total loss of inventory if they manipulate it. But the damage isn't contained to the silver market. You might be thinking, who cares if the COMEX breaks? I hold physical. You should care. Because when a major asset class breaks, when a clearinghouse trembles, the shockwave doesn't stop at the commodity desk. It hits the plumbing of the entire financial system. Silver is just the first domino. The next one is much, much bigger. Let's talk about the contagion event that the Fed is terrified of. Silver is a small market. It's tiny. But silver is the fuse. The bond market is the bomb. And the fuse has just been lit. We are shifting our gaze now from the commodity screens to the bond desks. The screens are flickering to life in Tokyo and Sydney for the Sunday session, and what we are seeing is the early tremor of a massive collateral spasm. You might be asking, why does a default in silver affect the U.S. Treasury market? It seems unconnected. But in the plumbing of high finance, everything is connected by one thing: liquidity. This is the collateral crisis scenario we have modeled, and it is playing out in real time. Here is the transmission mechanism. When a major bank gets hit with a multi-billion-dollar margin call on their silver position, as we've established they just did, they have to come up with cash immediately. T+0. They don't have billions sitting in a checking account. Their capital is tied up in assets. So what do they sell? They can't sell their real estate holdings instantly. They can't sell their private equity stakes. They sell the most liquid asset on their balance sheet, U.S. Treasuries. This creates a liquidity drain. We are watching a forced liquidation event where banks are dumping sovereign debt not because they dislike the bonds, but because they are bleeding to death on the COMEX. This wave of selling hits the bond market at the worst possible time. It drives the price of bonds down, which means the yield, the interest rate, spikes up. Look at the correlation chart on the screen. Historically, silver and yields often move in opposite directions. But in a systemic liquidity crisis, they spike together. That is the signal of a heart attack. We are seeing the 10-year Treasury yield pushing higher right now. That is the sound of the banks scrambling for cash. And this volatility triggers the next phase of the contagion, the repo freeze. The repo market is the pawn shop of Wall Street. It is where banks lend cash to each other overnight, using treasuries as collateral. It operates entirely on trust and the quality of that collateral. But tonight, trust has evaporated. If Bank A knows that Bank B is effectively insolvent because of a massive silver short, Bank A stops lending. They hoard their cash. The repo window slams shut. We saw this in September 2019. We saw it in March 2020. When the repo market freezes, the gears of the global economy grind to a halt. Credit stops flowing. Hedge funds blow up. The entire leverage tower begins to wobble. This forces the Federal Reserve into a corner from which there is no escape. This is the doom loop. The Fed cannot allow the repo market to break. They cannot allow a major bank to fail over a silver trade. So they have to step in. We are already seeing activity on the Fed swap lines. These are emergency pipelines where the Fed sends dollars to the European Central Bank and the Bank of Japan to keep their banks liquid. Basically, the Fed has to print money to fill the hole left by the silver losses. But here is the irony. Here is the trap. The very reason silver is exploding to $79 is because the market fears inflation and currency debasement. To save the system from the silver spike, the Fed has to print more money. Do you see the loop? The bailout validates the thesis. Every dollar they print to suppress the crisis is fuel for the fire. It tells the market, the dollar is broken, go buy hard assets. It sends silver higher, which creates bigger margin calls, which requires more printing. They are fighting a fire with gasoline. And amidst this chaos, there is a sector that is acting as a strange attractor for all this fleeing capital. While the banks are bleeding, look at who is winning. The capital fleeing the broken banking system has to go somewhere. Cannot stay in cash because of inflation. Cannot stay in bonds because yields are spiking. It flows into the only equity that holds real value, the miners. We are calling this the miners' revenge. For a decade, the mining companies have been price takers, crushed by the paper market. But in a solvency crisis, where counterparty risk is the number one fear, owning a share of a company that has physical metal in the ground, with no counterparty risk, becomes the ultimate safe haven. We are watching a rotation out of financial stocks and into resource stocks. This is the repricing of the ground itself. The structural damage is done. The meetings in Manhattan are wrapping up. The sun is rising over the Atlantic. Monday is coming. You have exactly one chance to position yourself before the opening bell rings. The meeting is over. The bankers have made their choice. Now, you have to make yours. We have spent the last hour dissecting the anatomy of a financial heart attack. We traced the initial seizure from that frozen ticker at $79.25. We did the forensic accounting on the 20-to-1 leverage ratio that turned a market rally into a solvency event. We walked through the emergency liquidation-only protocols they are likely deploying to save the clearinghouse, and we mapped the inevitable contagion that is currently bleeding into the bond market. The simulation is complete. The theory is finished. Now we deal with reality. In a few short hours, the pre-market session will begin. The algorithms will wake up. The capital will start to flow. And you are going to be faced with the most volatile, confusing, and psychologically demanding trading session of your entire life. The decisions you make, or fail to make, in the first 30 minutes of the Monday Open could determine your financial standing for the next decade. I am not here to give you financial advice. I am here to give you a survival guide for a system that is breaking in real time. I want to give you the Monday morning watch list. These are the 4 specific signals you need to monitor to know if the banks have regained control, or if the free market has finally taken over. First, watch the gap. When the market opens, the price is not going to crawl. It is going to teleport. You need to watch the opening tick. If silver gaps up significantly above $80, if we open at 82 or 85, it means the emergency meeting failed. It means they could not find a way to cap the pressure. It confirms that the panic is uncontrolled and the shorts are covering at market price. That is a melt-up signal. However, be very careful if we see a gap down. If silver opens lower, say at $75, do not assume the crisis is over. This is the hallmark of intervention. It means they successfully deployed a rule change or a coordinated central bank sell-off during the dark hours. But here is the key. Look at the spread. If the screen says 75, but you cannot find a single dealer willing to sell you a physical coin for less than 100, the gap down is a trap. It is a paper illusion designed to scare you. Second, watch the volume. Price tells you what is happening, but volume tells you who is doing it. If we gap up on massive, heavy volume, that is validation. It means the smart money, the whales, the institutions are panic buying. They are capitulating. But if you see a sharp move down on light volume, that is a rug pull. That is market manipulation 101. It is the machines trying to trigger your stop-loss orders to steal your position. In a liquidity crisis, low-volume moves are often fake. High-volume moves are the truth. Trust the volume. Third, look at the gold anchor. Silver is the volatile teenager, but gold is the adult in the room. Watch the price of gold. Is it holding the $4,500 level? Gold acts as the psychological floor for the entire precious metals complex. The banks cannot smash silver effectively if gold is making new highs. If gold remains strong, any dip in silver is mathematically temporary, because the arbitrage bots will step in to close the ratio. As long as the anchor holds, the ship is safe. Fourth, and most importantly, watch the yield spike. Keep one eye on the 10-year Treasury yield. If silver is rising and yields are spiking at the same time, it confirms our systemic failure thesis. It means the bond market is rejecting the dollar. It means the flight to safety is no longer into government debt, but out of it. If you see that correlation lock in, ignore the noise from the media. The system is in distress, and the metal you hold is the only insurance policy that pays out. Now, let's talk about your psychology. This is the hardest part. Rule number 1 for Monday morning. Do not sell early. I know this sounds counterintuitive. You might look at your screen, see a vertical line, see your account balance jump by 20 or 30% in minutes, and the temptation to ring the cash register will be overwhelming. You will think, I should sell now, lock in the profit and buy back on the dip. That is the trap. In a true short squeeze driven by a physical shortage, there are no dips. The price goes vertical. It goes limit up and stays there. We are witnessing a repricing event. The market is trying to find the new equilibrium where the paper price matches the physical reality. That price is not $80. It is likely much, much higher. If you sell your position at $82, you are trading a scarce, finite asset for a currency that is currently in the process of failing. You are trading the lifeboat for a ticket back onto the Titanic. Unless you have a desperate, immediate need for cash to pay bills, do not feed the beast. The banks need you to sell. They need your liquidity to cover their mistakes. Do not give it to them. Beware the shakeout. The volatility will be violent. We might see swings of $5 or $10 in a single hour. This is designed to break your will. They want to exhaust you. They want you to panic sell at the bottom or fear buy at the top. The best strategy in a vertical market is often inactivity. Sit on your hands. Turn off the minute-by-minute chart. Zoom out. Adopt the privatization mindset. Stop thinking like a trader and start thinking like a central bank. Central banks do not day trade their gold reserves. They hold them as strategic ballast. They hold them because they know that when the paper system resets, he who holds the gold and the silver makes the rules. You are now your own central bank. You are holding the collateral that the world is desperate for. Generations from now, financial historians will write books about the weekend of the $80 breach. They will analyze the charts we are looking at right now. They will talk about the moment the paper leverage broke and the physical reality took over. You are not just watching history. You are participating in the greatest wealth transfer of our lifetime. The paper age is ending. The asset age is beginning. The decisions you made to prepare for this moment, stacking when it was boring, holding when it was volatile, are about to be validated by the market. This is the end of the simulation, but it is the beginning of the reality. Get some rest. Check your security. And do not blink at the open. I'll see you on the other side. Ladies and gentlemen, the $79 price tag is merely the surface. The real story is the structural bottleneck in delivery and settlement mechanics where physical supply can no longer satisfy paper demand. Instead of reacting with fear, use the watch list we provided to verify the system's health yourself. clearly distinguishing between unverified rumors and confirmed structural breaks. Because when immense pressure meets a clogged pipeline, the danger isn't just the rising gauge. It's the moment when trust in the integrity of the pipe finally shatters.